So I've promised some of my viewers that I would talk about one loan that I had that blew up in underwriting. I did originate for 18 years before I moved out of origination and now mostly into the education and software side of the mortgage business. Some disclaimers before I tell you about this one incident. It was a time before uh, the requirement that the appraisal management company be used. We were able to talk with our appraiser directly, do the so-called value check, purchase loans. We really never did a value check because this particular appraiser believed that market value was the value of the property. So if the house was on with a realtor for some time, that whatever the price that was agreed between the buyer and the seller was the best indicator of what the value truly was. And yeah, we had a lot of value checks doing refinances, but the appraiser was very skilled. Was not only a residential appraiser, but also was a certified commercial appraiser, had a lot of experience with historical homes, rehabbing them himself, a lot of experience in expert court testimony. So we had a very experienced appraiser on our side back when the person was allowed to choose the team they wanted to work with. Another caveat was that in the beginning of my career, there were 2 or 3 times when I wasn't being watched as carefully as I should have been, where I forgot to ask the borrower something, and when the underwriter came back to me, the answer and the proof from the borrower was within the guidelines. So I dodged 2 or 3 bullets there. I also, as my career progressed, 2 or 3 times, I ended up just funding the loan out of my pocket, so to speak, becoming the lender instead of a broker when the lender wouldn't do the loan. But there was just this one that I was not able to solve in any way, shape, or form. Now, what happened was the account executive from a New York stock exchange traded lender. That lender is still New York Stock Exchange traded today, very active in the residential mortgage field, not going to name the lender. But this account executive came into my office and said that they wanted to make regular conventional loans, Fannie, Freddie. I don't particularly recall if they were one way or they did both Fannie and Freddie, as long as 2 criteria were met. One was it had to be a documented emergency, a real difficult situation that gave rise to the fact that their credit did not qualify. And this couldn't be just a letter of explanation. My car broke down kind of thing. I needed to make repairs. I missed some payments that got lost in the mail. It had to be a real severe documented incident. And the second criteria was that the incident had to clearly be in the past. And the borrower, other than credit-wise, they needed to qualify on all other terms. So the down payment had to be there, the DTI had to be there, the reserves had to be there. The only thing that could be off was the credit. So I kept that in the back of my head. And sometime later, I had a couple apply for a loan with me, and their child had been out playing on a pond in the winter and had fallen through the ice and had gone into a coma. And very fortunately, the child did fully recover. And I met the child during the origination process. This was a 10 or 11-year-old child. The child had been in a coma for a very long time, weeks, maybe over a month. And at least at that point in time, it had been the longest period that a child in a similar situation had been in a coma and made a full recovery. And for proof of that, they gave me a copy of a large, on slick paper, medical journal, and the story was on the front page. So it had these folks' names. I'm not positive if there was a picture of the child, but this was clearly a severe incident that caused them a lot of financial trouble. Unfortunately, there were two other children, younger children, not their children, but other children in the neighborhood who fell through the ice and passed away. And there were some in the neighborhood that thought that this 10-year-old, being the oldest child, was to blame and should bear the responsibility. And so there were death threats against the family. So all of this was brought by me to the account executive. And yes, this was perfect. This is exactly what they were looking for. So I disclosed the loan. They were moving out of the house they were in now. It was known that that house was going into foreclosure. They were many months behind on the mortgage at the time of application. And we had the appraisal done on the new house, and everything was fine. And the loan got packaged up, sent into the lender. And this lender was one that was generally slow, just every step of the way slow. And then 2 or 3 days before the closing, the lender told me they weren't going to do the loan because the borrower's credit score had fallen. Now, there was no credit score minimum criteria that ever came across on the initial approval or as conditions went in. But they said the score had now fallen too low, even though we knew they weren't paying the mortgage, they weren't going to be paying the mortgage, they were going to now be moving into this new property. So being an approved broker with this lender, they had sent me a copy of their annual financial report. And I got the lender file open. I've looked at the report. They had 3 executive vice presidents. One executive vice president had a third of the country. And I called that office and asked to speak to the gentleman. And I was told that he was going to be visiting an office about 2 hours, 2.5 hours away from me driving. Now, it was the end of the month, and I really wanted to hop in the car and make the drive, but just too many other loans closing, too much else going on 2-3 days before the end of the month. So they told me about what time he should be there, and I waited a little past that, and I called and told who I was and what was going on, and he came on the phone and had me on speakerphone, I believe, with the underwriter. There were a couple of other people in the background. Their exact roles weren't defined to me. And, he again said, no, they couldn't do the loan because of the credit score. And I told him everything that had happened, that nothing in the credit score had ever been mentioned, that this is the exact loan that they were looking to do, this type of situation. Well, they wouldn't do it. So I said to him, okay, I'll tell you what, if you'll make the loan, you keep all my compensation. I'll do the loan for nothing. No, they won't do that. So I said, I'll tell you what, you keep all my compensation, and I'll go to the bank right now, and I'll get a cashier's check made out for $2,000, and I'll overnight it to you. So you keep the compensation plus $2,000. No, we won't do that. I said, you got to be kidding me. You have put this family who's already had this stress, you're putting them in this situation. Can't you find a way, since you were going to do the loan, to keep it on your credit line, to keep it on your warehouse line? He said, well, we don't put loans on our warehouse line that we know we can't sell. So that's what happened. There were a couple of good points that came out of it, or salvageable points. One was that, fortunately, a local credit union stepped in and made the loan. It was a 5% down loan at conforming rates. So they stepped in and made the loan. The only other slight positive was that I had told the realtors involved and had told the borrower, look, I have every reason to think they're going to make this loan. I mean, why would they come in? Why would an account executive from a national New York Stock Exchange lender come into my office, tell me they wanted to do these loans, show them this medical journal explaining the problem? Why will they not do the loan when they promised they would? So I had told them I had no backup. Now, again, the credit union stepped in. It turned out all right. So the lesson for you newer loan originators, I was already, as a new originator, fairly new. I probably was a couple of years into my career. I knew never trust a lender. Never trust them. You need a backup. And I didn't have a backup. And I knew I wasn't going to be able to find a backup. So if you're new, you always want a backup. Now, I do hear these brokers, there's some of them that seems like they walk on water these days. They have the ability to contact an underwriter at one of their lenders to have a great discussion with them, and everything goes smoothly. That underwriter is the one that makes the decision. There's never a QC, pre-closing QC that comes up. Nobody ever pushes back. And my hat is off to those people that are that skilled, that have gotten to that level of competence to be the top 1%, that you can make a call to an underwriter and you know 100% they're gonna follow through. They're gonna make that loan. If you're newer, make sure you have a backup. And I'd be more than happy to respond to comments on this video. If you're a broker, do you normally get a backup if you've got a difficult situation? I don't mean when you've got a slam dunk 800, the back end ratio is 20, they got 4 years of reserves in the bank, there's no story to the loan. Yeah, do you need a backup for that? No, you don't need a backup because you know everybody's going to take it, and it's like almost 100% that the first place you send it to is going to take it. So you don't need a backup for that. I'm talking about that loan that has some underwriter discretion where you need to shop it. Do you stop at your first yes? Do you have that kind of confidence in your account executive or in the underwriter that you contact where that first yes is so good that you'll put a family at risk, your reputation at risk, that family at risk as to not having to move into a motel or move into a relative's basement when the loan falls apart? I'd like to know about your experiences there, please. If you'd like to get in touch with me directly, you can reach out to me either here through the video. I'm on Facebook. You can email me, Alan, ALAN, at complete1003.com. If you want to learn more about how I help newer loan officers close more loans faster, with two areas. One is making sure they know how to structure the loan if it can be made. And the second area, making sure that they haven't overlooked a question they need to ask the borrower. They haven't overlooked when there's some underwriter discretion, so they can clear the path with an AE or an underwriter, ideally with a backup. So you're able to see that the loans will close when you send them in. You can check out more about that program at complete1003.com. Well, that's it for today. I look forward to speaking with you if you're interested.